Congress now has less than a week to come up with a plan to raise the debt ceiling or risk the government defaulting on its loans. On Tuesday, a group of Republican senators introduced a bill that would require the government to prioritize its payments. They're proposing the government should pay interest on its debt first, then Social Security benefits and military payrolls. The debt ceiling debate has been the focus of Washington all summer, but you may not understand exactly what it's about or what it means to you. Jack Hough is associate editor for smartmoney.com, and he's here this morning to help us make sense of all of this. So thank you so much for being here. And really, for the average American, what does this mean to them?
It's pretty scary to look at, but I think that the important thing is not to panic right now. People just saw images of Greece with huge financial troubles over there, and now they hear about the U.S. risk of default, and they're thinking, all right, we're in the same position as Greece. Not nearly the same. They don't have the ability to raise more money. They don't have the ability to cut spending, and we can do a lot of both here. Revenues are still low relative to our history, relative to other peer nations. So there's room to get more money. There's a vast amount of room to make cuts. We just need a deal.
So what does it mean when we hear that if we don't make this debt deadline, then the U.S. will have its credit rating, its bond rating lowered? Okay,
so there's two words to pay attention to, and one is default and the other one's a downgrade. The risk of default I see is very low. We're going to pay our bills. We're going to figure something out eventually. However, downgrade, that's not necessarily up to Congress. That's a dozen bond analysts in Manhattan that go through and look at governments and figure out, how likely they are to pay their bills over the next 5-10 years, and they come up with their own rating. We can't necessarily stop S&P or Moody's from changing a AAA rating to a AA. However, I'm not sure the market cares if that happens, and the reason is because there are so many gigantic institutional investors, other governments, huge funds, that want to buy the world's most liquid investment. And they don't wait for S&P or Moody's to tell them whether to buy treasuries. They do their own math. And I think America remains a very prosperous nation, just with a little political logjam right now.
Okay, so that said, if we make the deadline, even if we're able to make August 2nd and everyone is happy, do you think the U.S. will still be downgraded?
I think it's possible. There's no way to know. It really depends, because it's not just about the numbers. There's some subjectivity to it. It depends on whether these firms are convinced that America has the political will in Washington to right its course financially. So we don't really have a lot of control over that. It could go either way. But I don't think it means that the world's going to bail out of Treasury bonds if there's a downgrade. I mean, maybe it's even odds, maybe a little less than that of a downgrade, but if it happens, I don't necessarily think there's a big financial fallout from it.
Will you see panic either way? One, if we don't make the deadline, and two, if there's a downgrade, even if the deadline is made?
I doubt very much you'll see panic in the Treasury market. You certainly haven't seen it so far this year. Yields remain very low there, and those investors tend to kind of stick. You might see it in the stock market, because stock market investors tend to get a little skittish. You might see a big sell-off in the stock market. If you do, look for buying opportunities. Look, governments can't get their house in order right now, but corporations remain very prosperous. Look for shares of big, stable companies that do business all around the world, that pay good dividends, have cheap shares. And that's a good place to park your money right now, rather than these Treasury bonds that pay you next to nothing.
So back to the average American, when we're looking at all of this, should we not make the deadline? Should there be a downgrade? Should any of this happen? How does that affect Joe Smith out there? I mean, are you going to see the mortgage rates rise? Are you going to see home rates rise? What are you going to see?
Well, in the president's speech, he said that if we're downgraded, then we could see interest rates rise across the board, higher mortgage rates, higher credit card rates. But so far, the thing that would lead all of that is the 10-year Treasury yield, and we haven't seen it rise. And financial markets don't wait around for the downgrade; they react on the anticipation of it. So I think that whatever would have happened has already happened, and
so
what has happened is
rumors.
Yeah, exactly, and they haven't really budged. So I think that the Treasury market is not The Treasury market is much bigger than the two tiny firms that put letter ratings on Treasury debt. So I think that the big investors who play in this market are so far not that concerned. They still see the U.S. as a very prosperous place. I would say for your viewers and people wondering what to do with their money right now, be careful about what looks like extreme answers to this. Don't go, selling everything you own and putting all your money into gold nuggets and burying them in the backyard.
Don't put your money on the sideline to wait?
I think right now you want to own high-quality investments. You want to own shares of companies that will continue to do business no matter what's happening with currency and treasuries and this and that. There are companies that do business all around the world whose products, whose goods and services we will continue to buy over the next 10 years. They're going to make good money. they're going to pay their shareholders good dividends, and they're going to retain value. I think that's a good place for money right now, and I think you keep some in cash. There's nothing wrong with dollars right now where you wait for buying opportunities.
Washington is obviously trying to find some kind of a solution here. Competing plans are out there. A lot of them have to do with the government and cutting spending. Does that mean we're going to see a loss in government jobs?
Absolutely. I think that's a sure thing. When you look at the number of government jobs, it's reached unprecedented levels where you have twice as many workers in the government as you do in manufacturing companies. It's never happened before, and it's not really sustainable. We don't need this many government workers, so I think surely you're going to see a loss of government jobs. And you could see a sort of dampening effect on the economy. I mean, you know, when you spend a lot of borrowed money, it heats up the economy, and when you stop doing that or when you draw down spending, it slows the economy. So you could see a slow period right now where people can look for investment bargains if assets sell off.
It seems like either way you cut it, there's going to be some kind of a trickle-down effect.
I think so. I think we had a lot of boom years. I mean, we had a quarter of a century of a boom, really, if you put it all together. And you know, it's reasonable to think that we might have to go through, you know, several years now where we just kind of wind down some of the excess, both in our personal lives and as a nation.
All right, Jack Hough from smartmoney.com. Great insight. Thank you so much. We appreciate it.